Hey everybody, we are going to talk about two dividend stocks that I think are excellent buys right now in particular, but just great companies in general. We're going to dive into those in just a second. Before we do, take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. I'll put that link in the video description as well. And please hit that subscribe button if you don't already to keep up with all of my content. So I'm going to talk about two stocks. They're both real estate investment trusts, and both look particularly interesting right now. So I'm going to share my screen. All right, so the first one is a company called EPR Properties. Ticker symbol is EPR. And this is a pretty small real estate investment trust when you compare it to some of the other ones we're going to talk about. It's got a market cap of about $4 billion. It has a 6.7% dividend yield, and it is one of the few real estate investment trusts that I like that actually make monthly dividend payments. The short version is that EPR invests in a portfolio of experiential real estate assets. Unfortunately, a lot of that means movie theaters, but it also has substantial holdings in things like water parks, ski resorts, and things like that. So here's a breakdown of the entire portfolio. So 154 of its properties and 38% of its rental income are from movie theaters. That is the biggest X factor in this company. The biggest thing I don't like about the business, the movie theater business is doing well right now, but its future is far from certain. Some of its tenants are not in the best financial shape. Its number one tenant is AMC Entertainment. So it strategically wants to reduce that. That rental percentage, currently 38, was closer to 50% not that long ago. So they've done a good job of getting rid of some of it. The second most common property type is what are called eat and play businesses. These are things like Topgolf, which is their number two tenant. And you can think of like a Dave and Buster's and places like that. Then you'll see attractions and cultural properties. Six Flags is a tenant of EPR, ski resorts, fitness and wellness buildings, experiential lodging buildings, and gaming is their smallest property type. They also have some education properties, which the goal with those is also to reduce their exposure over time. So that's where the portfolio stands right now. Over time, they see a big opportunity here. The experiential economy is growing very rapidly, especially in some of these categories. The eat and play businesses. Topgolf is growing quickly. Family entertainment centers, the kind of specialized bowling centers, I'd call them. Those are growing quickly. The gaming business is doing really well, especially in the regional sense, like outside of the major gaming areas. So a lot of these opportunities are growing. EPR sees a more than $100 billion addressable market. Remember, this is a $4 billion real estate investment trust. So big expansion opportunity. It's not growing that fast right now, and we'll get into that in just a second. But this is kind of the target of what the business is doing. So recently, its results have been very strong. It grew revenue at 5% year over year in the first quarter, despite minimal investment activity. Adjusted funds from operations, which is essentially the real estate equivalent of earnings, was up 8% year over year. EPR spent just under $38 million on investments. That's a pretty low amount for this company historically. But its business is doing really well. It just gave us a 3.5% dividend increase. Very manageable 70% payout ratio, meaning it's paying out 70% of its funds from operations. So that very sustainable dividend. I mentioned it's about a 6.8% yield. So not only a high yield, but a sustainable one as well. I mentioned they are gradually aiming to reduce the movie theater exposure and education portfolio, and they are making progress to that. In the first quarter alone, they sold 3 theaters and 11 of their educational properties, generating about $79 million in the process. So they're doing a good job of moving the portfolio to where it needs to be. It's a tough environment for growth. EPR increased its guidance. Its current properties are doing really well. Its dispositions that guidance actually was raised. It's selling properties quickly and more efficiently than it thought. Spending guidance for the full year is $200 to $300 million, which I mentioned is somewhat slow for this company. And the reason it's not investing more right now is because money's expensive. There's three primary ways EPR can grow. They can issue new shares to raise more capital. They can issue more debt to raise more capital, and they generate some extra money that they're not paying out as dividends, and from the dispositions of properties like theaters and education. So the first two are not happening right now. The company trades for a pretty low valuation of like 10 times FFO, which is great for investors, but not a great valuation if you're, diluting shareholders to buy more properties. Right now, interest rates are still high, so debt is not very good. So right now, pretty much all of their spending is being funded with their dispositions and the excess cash flow that the business is generating. So as rates pick up, the investment activity should as well. But for now, it is pretty slow. And right now, like I mentioned, it's a really cheap stock, great dividend, well covered by its earnings, and it's worth a look. The second stock that we're going to get into is Realty Income. Ticker symbol is O. I've talked about this one many times. It's a large real estate investment trust. It was the first real estate stock I ever bought. It's about a $50 billion company, so more than 10 times the size of EPR. It is also a monthly dividend payer. It actually has a registered trademark on the phrase the monthly dividend company. Has a 5.9% yield. And this is the largest, what they call a net lease REIT, which essentially means it owns single tenant properties, with about 15,600 properties in its portfolio. About 3/4 of its rental income is from retail. And we'll go through some of what they own in just a second. But fantastic track record of returns. If you look on the left side here, it went public in 1994, and since then, an average 13.6% annual total return. That's handily outpaced the S&P 500. Excellent growth. If you look at that bottom stat, 29 out of 29 years since they've been public of positive total operational returns. Great dividend growth, great credit ratings, and a big market opportunity. Here's that market opportunity right here. So pretty much all of their properties are in the U.S. today, for the most part. They've recently started to expand into Europe, and most of that is in the U.K. so far, but they've started to branch out a little bit. One interesting fact about Europe is that not many properties are owned by real estate investment trusts. That's a very American concept so far. So right now you can see that net lease properties are in the U.S. are owned about 4% of them by real estate investment trusts. In Europe, it's about 0.1%. So big opportunity to acquire properties in the European market. When you combine the two, that's roughly a $14 trillion market size. So even though Realty Income is very big, doesn't mean it doesn't have room to grow. So it has its freestanding retail property. That's its bread and butter. Talk about some of its tenants in a little bit. Industrial is the second largest property type. They see that as a big opportunity going forward. European properties are a pretty big opportunity, as I just mentioned. That's actually the biggest opportunity on the list. Gaming properties, the company just recently started getting into. They bought the Encore Boston Harbor from Wynn Resort. It's occupied by Wynn Resorts. Through a joint venture, they bought some Las Vegas properties. And they're just starting to get into data centers through a partnership with Digital Realty Trust, the leading data center real estate company. So really interesting opportunities. If you're curious about the retail part, it's generally companies that are not recession prone, that sell things people need, that sell things at a discount, that provide services. You can see their top tenant is 7-Eleven, actually, followed by Dollar General, Walgreens, companies that sell non-discretionary items that people need. So really solid investment strategy here. So the elephant in the room is that Realty Income, I mentioned the long-term track record, but like over the past decade or so, Realty Income has significantly underperformed the market. It's produced a 93% total return over the past 10 years versus 236% from the S&P. Pretty big underperformance, but consider what's going on. So real estate is arguably the most rate-sensitive area of the market. And over the past decade, we've had two periods of rising interest rates, one very sharp, the 2022-2023 one, Even after some rate cuts in 2024, the federal funds rate right now is still more than 400 basis points higher than it was a decade ago. So that's, not a great environment for real estate. So pretty solid returns despite that. We also experienced the global pandemic that lowered interest rates temporarily, but also made a lot of retail tenants that were on that screen I just showed you unable to operate for a while. So right now, the valuation just looks great. The dividend yield, 5.8%. That's the highest you could get from Realty Income since the financial crisis era, save for just a few blips along the way. It trades for less than 13 times its 2025 FFO estimate. That's the lowest valuation since the 2008-09 era. Tons of growth opportunities and a great history of capital allocation. This looks like a fantastic time to get to take a closer look at Realty Income if you haven't already. Love to know what you think about EPR and Realty Income. Leave me any comments you might have. I'll do my best to respond to them individually. Thanks for watching, and stay tuned right now for a message from The Motley Fool. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.